Right. So today I'm gonna chat about some of the key themes that market participants are talking about at the moment, and then I'm going to talk about how I manage some of those things in the context of the fund that I run. Now, so I'll talk about the rotation trade, which both Pete and Nolan have spoken about, and some of those themes. I'll talk about, quite briefly, why I think the actually long-term secular backdrop is really unchanged. And then I'm going to talk about the Anchor Global Equities Fund's strategy, which is really focused on a small group of companies, which I call multibaggers, and how they fit in within that, both the shorter and the longer term timeframes. Right, well, let's look at what is the consensus narrative at the moment, how are investors positioned. So as Nolan mentioned, one of the dominant themes or discussion points over the first quarter was rising expectations with regards to growth and inflation. Now, this chart is taken from the Bank of America Fund Manager Survey, and it shows investor expectations regarding inflation. So when this line is rising, it says inflation expectations of future inflation are rising, and when it's falling, expectations regarding inflation are falling. Now, what you can see is that inflation expectations are higher than they've been in the whole survey period, which is roughly 25 years. So certainly investors are expecting inflation. The other thing, and consequently, the factor that ties in with those rising growth and inflation expectations is that investors are positioned in cyclicality and in value shares in favor of value shares over and above growth shares. So they're positioned in materials, industrials, and financials. And so if you look at this chart shows the number of investors that think as a percentage that value will outperform growth. And again, it's the highest we've seen in the survey's history. Now, typically, when you see investors really all on one side of the boat, historically that's a contrarian indicator suggesting that it may be time to look the other way. Now, I'm not suggesting that growth is suddenly going to rocket and value shares are going to crash. But what I would suggest is that these themes which dominate the narrative at the moment, they are no longer contrarian, and they are very much consensus. And as such, you wouldn't expect these themes and these factors to generate some of the outsized performance that they have over the last couple of months. So I'll just put that out there as the first thought, at least sort of short to medium term. One of the major narratives, along with rising growth, inflation, value over growth, has been that rising interest rates are bad for growth stocks. Now, historically, this narrative is not supported. It's just not supported by data, and it's not supported by history. So what this chart shows, it plots the NASDAQ, which you can think of as representative of growth and technology shares. The NASDAQ is the dark blue line. And then I've plotted with the light blue line is the yield on the 10-year US Treasury. So what I've denoted different shaded areas to show what happens when interest rates fall and then when interest rates have risen. And what you'll note is, regardless of the regime, whether interest rates have fallen or risen, the NASDAQ has gone up consistently over the last 10 years. So I've just taken a screenshot of a snapshot in time, the last 10 years, but this holds through other periods in time. So the next pushback might be, well, interest rates are extraordinarily low at the moment, and so growth stocks are certain to do badly when interest rates are higher and rising. And so the counterpoint to that argument would be the late 90s tech bubble. So over that time frame, long-term interest rates, the US 10-year was roughly between 4 and 6%. And what's most interesting was the steepest part of the rally in the NASDAQ in the late 90s occurred between sort of mid-1998 and early 2000. And that coincided with a period where the US 10-year went from roughly 4.5% to just under 7%. So not only were interest rates relatively high, but they were also rising quite dramatically. And so, to my mind at least, I think this the focus on interest rates is a bit of a red herring. And I think what is more important is liquidity and animal spirits and investor risk appetite. If we look on a more kind of secular basis, a long-term basis, I came across an interesting piece of research that shows that perhaps counterintuitively, interest rates actually bottom well after the end of a recession. So what this chart plots since 1954 till the present time is the US 10-year yield, and the shaded areas are recessionary periods. And then you can see what the beige squares denote is that if you look after every recessionary period, the interest rates have actually troughed multiple months or even multiple quarters after the end of the recession. So that would suggest, if past is precedent, that interest rates could actually fall to well below their trough that they experienced last year at some point over the next couple of quarters or years. I'm not saying that's guaranteed, but that would certainly be unsurprising if history is any guide. So I certainly don't believe that that lower interest rates are needed for growth shares to do well, but it's certainly on a relative basis that would be favorable for growth shares. And then why do I think that? I think disinflation is a much more likely outcome than inflation on an extended secular horizon. So I'm certainly not talking about the next couple of months, the next couple of quarters, or the next year even. But I don't think we have escaped the pre-COVID, post-financial crisis era that we were in before. So the first thing is debt. Debt levels globally are much higher than they were even around the sort of roughly the 10 years post-GFC. Government debt has risen dramatically. And as governments have to service that debt, that reduces the amounts of money that they can spend on other things. And as they fund that using by increasing taxes, that takes money away from the private sector that effectively acts as a dampener on demand. Secondly, demographics. You're seeing slowing population growth in most of the world, and you're seeing aging populations. So both of those factors are inherently disinflationary. And then finally, which I think is arguably the most important factor, is the acceleration of technology and technology adoption, new energy solutions, and I think we're in the early days, and I call it a Cambrian explosion of technology adoption, new ideas, new technology, and it's fundamentally disinflationary. So if you can replace your pay TV that costs you 1,000 Rand a month, 900 Rand a month, with Netflix that costs you 150 Rand a month, that's inherently disinflationary. If we're moving to a world of electric cars, that's going to reduce our dependence on, and it's more of a energy is driven more by renewables like wind and solar. That's going to lessen our dependency on coal and oil, and that reinforces that chart that Nolan shared, where energy is just a smaller part of the basket. We're talking about a less inflationary world. Now, so my strategy is I am really ruthlessly focused or relentlessly focused on multi-baggers. Now, multi-baggers are companies and shares which can grow 5x, 10x over the next 5 to 10 years. So if you think about, Amazon over time, Netflix, Tencent, back in the day you had Walmart, these kind of companies, and they can make a world of difference to your portfolio. What I'm trying to describe with this slide is in order to find multi-baggers, you need to use both sides of the brain. So fund managers, if you look, are typically quite left brain oriented. We're very spreadsheet driven. We're very logical. We're very numbers oriented. And that's all fine. But that's not enough if you want to find multi-baggers, which tend to be or are often fairly controversial, fairly unorthodox. The numbers often are quite murky and don't make sense. The leaders of these companies tend to be controversial. Think of Steve Jobs. I mean, we remember him very fondly now, but he was very controversial back in the time. Leaders like that. And so you need to lean into, in my view at least, you need to lean into the right side of the brain that's, creativity, imagination, things that are unorthodox, things that are that can be quite squishy and difficult to wrap your head around. And so you typically won't hear fund managers speak about that too much, but I think it's a really important, it's a very, very important input in finding multi-bags. So these are the top 10 holdings of the Anchor Global Equity Fund at the end of at the end of April. What you'll notice if you eyeball the holdings is that you probably won't recognize most of those names. This is a very different portfolio than you will see a lot of other fund managers hold, and that's really by design. We want to hold the names with the highest long-term potential, and because we like these, and they tend to be quite unorthodox at times. And so I'm going to talk very briefly about two of them. So the first name is called Sea. It's a company that's headquartered in Southeast Asia. Tencent owns roughly a third of the company. And Sea is a gaming and e-commerce company. And they were responsible for a hit game called Free Fire. It's a mobile game. If any of you have children that play Fortnite, this is like Fortnite, but Fortnite for emerging markets. And last year, this was the most downloaded mobile game in the world in 2020. At the end of the year, there were over 610 million people that played this game, and that's up from 350 million people at the end of 2019. And this gaming division, this game, is stupendously profitable, and operating profit grew 150% year on year in the fourth quarter of 2020. Now, what multi-baggers do and what C does is they don't just rest on their laurels. They don't just harvest the profits and pay it out as a dividend. What they're doing is they're taking every last dollar from their gaming division and they're reinvesting it in Shopee. Now, Shopee, on the slide, you can see the homepage of Shopee, which is their e-commerce site, and they operate right across Southeast Asia, which is a population of roughly 650 million people. Their biggest market is Indonesia, which has approximately 260, 270 million people. So it's a massive, massive country. And e-commerce penetration is, roughly mid to high single digits. So it's very, very early days. Now, Shopee was the most downloaded shopping app globally in 2020. So C is building the Amazon of Southeast Asia. And the numbers that Shopee is putting up are also simply incredible. So revenue grew almost 180% year on year in the fourth quarter of 2020. And now they're just starting to dip their toes into South America, starting to set up a presence in LATAM, in Brazil and Mexico. They're really the Free Fire, the game is really popular there. And they're using that as a way to build local awareness. Now, so C is the largest position in the fund, and partly it's got there because the share has done so well. So the stock has been roughly a 10-bagger for the fund since we bought it more or less this time 2 years ago. So that means the stock has gone up, call it 1,000% in the 2 years since we've held it. And at no point in that time has it been has it looked like a very, very clean story. It's never looked like a Nestle or a Google. It's always, you've really had to peel back beneath the surface to see what was going on. And I make the comment on the slide, sell discipline revisited. As a fund manager, I often get asked, what's your sell discipline? When do you sell? And I think the real discipline comes in, if you think you found a multi-bagger, the discipline is to not sell. The discipline is to hold and to hold and to hold. And as long as the company's executing and they're growing and increasing their market share and going into new markets, the real discipline is not to sell. And frequently these shares look very expensive, and they will pull back, and they will suffer corrections. But it really, really pays to have a long-term horizon with these multi-bagger companies. Next, now, one name that you will recognize and which Pete mentioned is Tesla. Now, Tesla has got a very controversial CEO. It's a controversial stock, and that makes it interesting. Now, this is a picture of a Cybertruck. It is a visual embodiment of this company. It's very edgy. It's either cool or hideous, depending on your perspective. The Cybertruck, I think, is going to be launched likely sometime next year. And I think it is just going to be, even if, my wife thinks it's the most hideous car she's ever seen, but I think there are going to be millions of people, if not tens of millions, perhaps hundreds of millions of people that will want to buy this car. I think it is going to be an absolute monster seller. Now, Tesla sold or delivered around 500,000 cars last year. I think they've got a shot at selling 1 million cars this year. The consensus, the sell side currently thinks that they're going to sell 860,000 cars. We'll see where that ends up. That's not the most interesting part of the story. As we look further and further out, I think Tesla's lead just grows and grows and grows relative to the incumbent automakers. I think by 2025, they could be producing and delivering 5 million cars, whereas consensus, the street, the sell side, thinks that they're going to do just over 2 million. I think they could actually call it 2 million next year and sort of beat the street's 2025 estimates by early 2023 in terms of the run rate of deliveries. So the pure EV side, I think, warrants, in my view, a much higher share price over time. And my view is that Tesla is going to be to the 2020s what Apple and the FANG stocks were to the 2010s. I think Tesla has got a shot, a decent chance of becoming the world's largest company over the next 5 to 10 years. And I think potentially become the world's biggest company by a long, long way. And so I've listed some things on the right-hand side, which starts going into the realm of science fiction, but I think have a chance of just being, absolute game changers, not only for the company and their profits. And on that note, I think Tesla is going to be stupendously profitable over time. But these technologies are going to be game changers for the world and are going to change, frankly, how we live. So I think it's a very exciting company. I'm extremely bullish on it. Unfortunately, there's not time to delve in it any deeper. This chart is the unit price of the Anchor Global Equity Fund since the start of last year. We had a fantastic run last year, and then more recently, as interest rates have gone up quite sharply, that has been a headwind to recent performance. As the US 10-year has stabilized over the roughly last 6 weeks to 2 months, performance has started to bounce back. I really don't focus on short-term performance, and I really encourage investors in the fund not to focus on short-term performance, but to really think in terms of 5-year plus horizons. But that said, I think I think the factors that have been a headwind to the fund are sort of largely priced in. I think that rotation has already taken place. So incrementally, I expect them to be less of a headwind than they have been thus far. But certainly, I remain very, very bullish on the companies in the portfolio. Covered C, covered Tesla. It is difficult for me to be anything other than just super, super bullish, because these companies are changing the world and they've got so much growth left ahead of them. Peter mentioned some of the performance statistics earlier. Frankly, we had a fantastic last 12 months. Hard to say what performance is going to be going ahead, but again, very, very bullish on the underlying fundamentals. One thing that I would like to highlight is using a multi-bagger as a case study in why long-term thinking is just so important, and what, in retrospect, these companies, it would seem easy to have held an Apple while it's done so well, or an Amazon, or a Netflix, or even a Tesla. You think, I could have. You look at the chart and you scarcely see the blips, and you think it's easy. But unfortunately, the reality is just not like that. So this is a chart of a company called Mercado Libre, which is held in the fund. And over the last decade, Mercado Libre has been a 10-bagger. A 20-bagger. That means it's gone up 2,000% over the last 10 years. And Mercado Libre is the Amazon of Latin America. It's headquartered in Argentina. And if you know anything about Latin America, you know that it's a region with high inflation or hyperinflation. It's had very mediocre economic growth. Currencies have been weak. It's just been a really, really tough place to do business. And yet, despite that, Mercado Libre has absolutely trumped the macro environment and has been a fantastic stock. But holding it has not been easy. So the gray shaded areas the red shaded areas are periods where the stock has traded 20% below its all-time high. And so it's sat at least 20% below its all-time high 1/3 of the time, which is it's easy to just say that, but when you hold the share and you're down well off its high, it can feel quite rough. And in the last 10 years, remember, this is after the global financial crisis, it's had a maximum correction of 46%, which is certainly not fun to go through. And you can see that on the bottom left of the slide in that red block, it looks today like a tiny little blip. And that, I think that also that illustrates if you've got a long enough horizon, what can feel terrible at the moment, ultimately in the fullness of time, is just a tiny blip in the rearview mirror, as long as you've picked the right stock. So this is what we're trying to achieve. You've got to earn your returns, the multi-baggers. It's not a smooth ride, but certainly I believe the rewards are certainly worth it. So just to summarize and to conclude, I think, as I've highlighted, I think the rotation trade is very much consensus. It's no longer contrarian. And so I don't think you can expect the same rewards that you've had until now over the past couple of months. And I think what has been a headwind for growth shares and multi-bagger shares, I think becomes less of a headwind looking forward. I personally don't think the secular backdrop is unchanged. I think, if anything, some of these factors that are acting as a headwind to inflation are actually becoming more pronounced. And then finally, I hope I've outlined the case for multi-baggers and why the shorter term pain, why the shorter term pain is worth accepting as a trade-off if you want to make those longer term gains.